Hello guys, you are welcome to my YouTube channel. My name is Sunday and my YouTube channel's name is Harvey Forex. Uh, you are welcome to this episode and like I promised us, I'm going to be, you know, giving it to us step by step so that at the end of the day, at the end of the training, we'll be able to beat our chest and say, okay, we can now stand on our own and trade in the forex market, the financial market. You know, if you are new to my channel, please subscribe, hit the subscribe button, drop a comment if you have any comment. And if you want me to coach you one-on-one, like I already have students that I'm coaching, you just send me an email or you drop a comment at the comment section so that we can schedule. Then I will hold your hand and walk you through step by step to become a professional in the field of financial market, how to trade forex indices, even any form of financial market. You can trade indices, cryptos, shares, and all that. So once you get the basis, you can walk yourself through any financial market at all that you want to trade. Be it crypto, you can trade it. Be it indices, shares, and all that. That being said, today I'm going to be teaching us the type of forex traders. In forex we have different types of traders. So we don't trade the same way. All forex traders don't trade the same way because you need to first of all check your daily activities, and you will now be the one to now choose the one that resonates with your schedule, because most of us still keep our normal traditional job that we do rather. So, and we use this as a source of additional income, and we have so many who use this medium as their income. This is what they do. So if you are that type that maybe you have time that all you want to do is you focus on trading forex, you want to take it as your job, all you need to do is get a place in your apartment, just isolate that place, make it in form of an office for yourself, and you will have time for yourself to trade. Maybe you have families and all that, but once it is time for you to trade, because you are the one that will choose the session that you want to always flow with. If it is London session, you know the time they open. If it is New York section, because New York and London section, they always overlap. If it is Tokyo session, you decide. If it is Asia session, you'll be the one to decide because time varies, you understand? So you have to work with the time. So you will be the one to choose the time that is suitable for you. So once that time comes, you have to sit. You have to get seated and trade. So that is how it is. Having said that, we have types of forex trader. We have the position traders. Position traders are long-term traders whose targets are based between 500 to 1000 pips before they can sell or before they can buy. We should understand now that in trading, we either buy currencies or we sell. So that is how it is. And if you are trading, if you are going long, when I use the word long, if you are going long, that means you want to buy when the the price action is bullish, then you place a buy order. Then as you place a buy order, as soon as that order hit your target, what you do is you buy and sell at the same time. You buy and you sell at the same time. So that is how it works. That is why we always have pairs, currency pairs. You cannot just pick only dollar and be trading with it. No. Let's say, for example, if you go to a place where they do exchange, at that point where you come to either change your own currency, you are living there with another currency. Or if you are coming to buy a currency, you are living there with another currency. So you drop your own, you collect another one. So that is how it is. That is how it is in financial market. It's the same thing. You might be wondering, I don't know how to trade forex. And you have traded forex in your life. If you have handled your own country currency and you want to turn it to another currency, you want to exchange it to another country currency, that is just forex trading. So the position traders are long-term traders whose targets are based between 500 to 1000 pips before they can sell or buy. All these ones are mostly financial institutions, financial body, because what they do, they target higher. You can imagine 500 pips. When you use the word pips, I've already thought of price interest point, the number of movement. Then if you place a buy order, it has a step just like you climbing a staircase. 1, 2, 3, 4. You are climbing a stairs. So that is what we mean by pip. A pip, you have 1 pip, 2 pip. As the price increase per pip. So that is how it is. I hope we are clear. So the position traders, they target a very high amount. So that means before you can get this, it can take sometimes 1 week, it can take sometimes 1 month, it can take some time. Just like that, it's a long-term something. So it's like that. They have the money and they target bigger amount. So that is how it is. Position trader, they always hold trade for a very long time before they sell or buy. What do you mean by before they sell or buy? Meaning that where they put their target is always very long. Is the distance between the point of entry and the target point is the distance there is very long. That is how to describe your target point. The distance between your entry point and your take profit target. So what they do, they take count almost, let's say, 500 to 1 pips, and even at sometimes they take more than 1000. So it's like that. Anywhere you see D1, because once you open your chart, because very soon I'm going to be, you know, taking us through how to create an account, then you now see a platform, how a trading platform looks like. If you have seen it, okay, but I will still explain to us the things that we will see at the dashboard, the top, once you open the application, the platform where all these activities is being carried out, you will see all these things so that it will not be new to you. Because very soon I'm going to push us through we how you can create your account, select your broker, then open your demo account so that all these things that I've taught you guys, you will now start practicing it. But before then, I'm going to teach us about um, risk management. Risk management, because most people, what they do is they just jump into it at the end of it, because they see that it's very easy to make money, and at the same time it's very easy to lose your money if you don't apply, if you are not strict with risk management. You just jump into it, and what you first of all do as you are placing your entry, you must first know where to put your stop loss. If you don't know what I mean by stop loss, you go and watch my video. Stop loss, it's a protection for your loss. Now, before you place an order, you'll be the one to say, okay, after your analysis, you now place an order, then you look at where your stop loss will be. You know, it is always advisable that we take 2 to 1. Let's say, for example, if we are to place a trade, you place a trade where you can gain twice. If your analysis is wrong, you lose 1. Let's say you gain 2 to lose 1. So that is what we call that risk management, risk reward ratio. That is how it is, guys. As we progress, you are going to know all those things better. So when you see D1, it means daily candles. Daily candles simply means that a candle, it will take a whole day before it will be fully full. A whole day before a candle can close, it will take a whole day. That when you see D1, that means it's daily candles. Then when you see W1, it means weekly candles. There are candles, it depends on the time frame. All those things are time frame. I've already taught us time frame. When you want to start your analysis, you start from the bigger time frame, then you now come down, you scale down to the smaller time frame where you are to execute your trade. Because the bigger time frame, if you identify any resistance or support level, price action will always respect those levels at the bigger time frame, even though you are executing your trade on the lower time frame. You will still say it. You understand? So it's like that. It's very simple. Don't get confused. So weekly candle, this, whenever you see W1 means weekly candle. Note, they are able to do just one trade, but with high risk reward ratio. Like I told you, like I just told us, once they place a trade, they just leave it to run. It can run for like 1 week, 1 month, they don't care. You understand? Instead of you now, just like a retail trader who targets like 10, 15, 20 pips. Under 15, 30 minutes, your trade, you close the trade and you wait for another opportunity and place another trade again. But in case of all those position traders, what they do, they just place one trade. That trade can run for like 1 month, 1 week, 2 weeks, 3 weeks, like that, before it will hit their profit target. So what they do is that they are able to place just one trade. Then we have the swing trader. Swing traders, these are short-term traders. Usually, those people usually close their trade or their chart between a couple of days or weeks. Between a couple of days, it can be 3 days, 4 days. It can last for 1 week or even 2 weeks. Why those ones can last up to a month. So it's like that. Their target is from 50 pips above before they buy or sell. Their target is always above 50 pips. That is swing traders. When you see H1, that means every 1 hour candle. Means every 1 hour candle. H4 is 4 hours candle. Anyway, you see H4, all those things you are saying, I'm just showing you, you will see them yourself. H4, H1, W1, W1, D1, and all that. But the timing, you will see 15 minutes, 10 minutes, 5 minutes, 1 hour, 4 hours, like that. Then we have day traders. Day traders are short-term traders who close charts within a day, and their target chart is between 20 to 40 pips before they buy or sell. I think here most people who are retail trader falls under this, because people want to just trade and get their profit. They don't want to be greedy. They just place their trade, place their order under 15-20 minutes. They close their trade and wait for another opportunity. So what they target, their interest is in they're able to target up to 10, 20, 15 to 40 pips. They are okay. So that is just how it is. We have the 15 minutes candle. We have the 1 hour candle, like I've told us. We have 4 hours candle. Then we have all these ones, they all the these 15 minutes candles and 1 hour candle, 4 hour candles are what those traders do, the daily traders. They just use like 15 minutes candle, 1 hour candle, 4 hours candle, because for them to be able to trade and close their trade fast, because one candle will run for 15 minutes and close. If your time frame is 1 hour, if you are executing your trade on 1 hour, that means it will take 1 hour for one candle to close. If it is 15 minutes, it will take 15 minutes for a candle to close. If it is 4 hour time frame that you are using, like I said, it depends on your time, your activities, what resonates with you, what you feel okay. Maybe usually I don't have much time because I'm very, very busy, but I can always spend like 2, 3 hours on my system, or I can always have time to check my system like 2, 3 times. So if you're that type, you know that maybe a 1 hour time frame or 4 hours time frame that you choose. So it's like that. You have the scalper traders. These are traders who buy and sell immediately. Their target is between 5 to 10 pips and they close chart. The scalpers, what they do is they just, once they see opportunity, enter the market and boom, they are out. Enter the market, take profit and out. So as they do it continuously, just like you enter the market, cash $50, you close your chart, you close your trade, you wait for another opportunity, enter, make 50 bucks, you come out, enter again, make 50 bucks, you come out, instead of waiting for a trade to continue to run. So people like that, what they do is they don't have time to start waiting for maybe 100 pips, 50 pips, and all that. Because along the line, there is what we call impulsive move and retracement move. Because if 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 it is trendy, if price action is trendy, you see a trendy, you are trading a trendy market, and you see it bullish, it cannot continue to go bullish the whole day. That is what we call impulsive move, then a retracement. It will go bullish, then it will come down. It will reverse and you see it coming down. If you are not experienced, you just jump out. You think it's coming down to hit your stop loss. But sometimes it do happen. It does happen like that. In a bit of with price action going bullish, you might think it's retracing. If you're not that experienced, you might think it's retracing. It's just normal pullback that it will still make an impulsive move again. But at the end of the day, it turns out that there's a change of trend there. That is why you have to master very well your trading strategy, your candlestick patterns that I've already taught us. You have to master all this, because by the time you see a particular candle, you should know that there is change of character is about to happen. What you need to do at that point is to close your trade. Take the profits that you have already made. So we have technical indicators, like I touched on it in my previous video. Technical indicators, they are the tools that forex traders use, and they serve as a dynamic support and resistance level. That is what technical indicators does for us. We have types of technical indicators like SMA, the simple moving average. These indicators tells us the direction of the trend and act as a dynamic support and resistance. The SMA, once you open your chart, you activate the XMA. That is a technical indicator. Once you activate it, what that means is that it will be flowing as the trend is going up. You see the moving average will be acting as a support. Now, if there's a change of character and the trend is coming down, is bearish, you will see that the moving average will now be acting as a resistance to the trend. So most traders only use that as their strategy. And we have the 8 SMAs, we have the 20, we have the 50, we have the 200 SMA. What it then means is that, like say for example, the 200 moving average, if you use 200 moving average, now you have to just wait for the trend to be trending above. Once you see a trend trending above 200 moving average, I'm telling you that is bullish trend. It's bullish. By the time you see it trending below, we now see that the 200 moving average is now up, acting as a resistance. At that point, the trend is bearish. So most people, most traders, even professionals, they use that. That is their strategy. They just use that as the price action is trading above it, all they do is buy. As the price action is trading below it, all they do is sell. So it's like that. By the time you are advanced, you just keep it real simple. The SMA is calculated by adding the price of an asset over a given number of periods, and then you now divide the sum by the number of periods. All these things is just for learning sake, how the SMA works. It calculates the number of assets. It calculates the number of assets. It adds, the number of assets together. Then it will now divide it by the time period. You understand? But all these things, you don't need to worry about it because system has already, perfected all those things for us. We don't need to start, let it not be as if, oh, you are saying, oh, how am I going to be doing all those calculations? No, you don't need to, all you need to do is open your chart and just activate it. It's already calculated. All these things is just for you to know how the SMA works as you use it to trade. So it calculates by adding the price of an asset over a given number of periods, and then divide the sum by number of periods. The total sum, you now divide it by the number of periods. It will now give you, that is how you will now know how the SMA, simple moving average, function. So it's just for learning sake. Then we have the exponential moving average, the EMA. All these things are types. Anyone you feel like to use, you use it. But at the end of the day, they are almost the same thing. They act as dynamic support and resistance too. That is how that is their function. They act as dynamic resistance and support tool for traders. The exponential moving average gives more weight to recent asset price, and is designed to respond quickly to price change. Like this exponential moving average, this one is particular on the recent, where we at that point in time that you are trading. But the SMA, the simple moving average, it calculates, it goes back to calculate. But this one focuses on the present, what is really going on at the moment. That is what the exponential moving average calculates. It focuses on the recent asset. Then we have, because at the end of the day, you'll be the one to choose the one that you like best and use. There are so many. So we have force index. Force index is a technical analysis indicator that measures the amount or volume of power used to move the price of an asset. You see how this one functions? It's a technical analysis indicator that measures the amount of or volume of power used to move the price of an asset. So you see, they function differently. But at the end of the day, you just see they act as an indicator to direct you, to let you know that, oh, at this point, price action is bearish. So once it's bearish, you see it acting, as a resistance. If it is bullish, you see it acting as a dynamic support. One thing we should know is that the force index is calculated by you subtracting yesterday's close from today's close. And when you subtract yesterday's close from today's close, then you now multiply the result after the subtraction by today's volume. If close price are higher today than yesterday, the force is positive. If close price are higher than yesterday, the force is negative. So that is how the Fox index functions. Then we have another one that we call MACD, MACD. We have moving average, convergence, and divergence. It's an indicator that tells us whether the momentum is bullish or bearish. This one, when you plot it, once you activate it, what it does is, as the momentum is going up, it will signal you, it will tell you. As the momentum is going bearish, it will signal you. You will see it. Once you watch your chart, you will see it. So that is how the MACD functions. A continuation of technical indicators. We have another one that we call momentum oscillator. This momentum oscillator measures the speed and change of price movements. It measures the speed and change of price movement, the way, the speed, the rate at which price changes. This one, it measures it. It's an indicator that measures when there is overbought, asset price rising too high, that is overbought. If the asset price is risen too high, that is overbought, and oversold when asset price falling too low. So the more the oscillator is an indicator that measures when there is overbought and oversold. How to read candlestick chart. Like I've given us types of candlestick chart, patterns, I've shared lots with us. You cannot trade all. Like I told us, all you need to do is you have to master one and apply it to become your own strategy that you will now be using to navigate the forex market. You stick to one. That is how it is. But the good thing is that you need to know all, study all, know all. Moment you open your chart, as price action is going, you will just notice if there's going to be a change of character, you will see it immediately and you know what to do. As you open your chart, where price action is at that moment, you know what the market is doing. That is how to become a professional trader. You don't need to stress yourself too much. Green body candle is a bullish candlestick that opens low, opens at the bottom, and closes high. If it opens, for example, it opens here, you will see it going up, it can close here. Even if there's a wick here, if you don't know what wick is all about, go and watch my previous video. It will open here, close here, or sometimes it can go and cover even this wick. You will not see anything. So the green candle, that is a bullish candle, opens low here and close high. That is what it means. Note, green candle, when the closing price is above the body of the candle, we say day high. And when the opening price is below the shadow of the candle on the candlestick, we say day low. So it's like that. It's very clear, self-explanatory. It's simple. Red body candle is a bearish candle that opens high. If it's a bearish candle, it opens high and closes low. If the candle is bullish, it will open from here and come down to close. But if it's a bullish candle, it will open from down and go up to close. If it is a bearish candle, if it will open from up here, it will start coming down to close. The red candle, when the opening price is above the body of the red candle, means day high. And when the closing price is below the body of the red candle, we say day low. Now, if, let's say for example, the bearish candle and bullish candle opens here, it will close here, but it gets, before this candle closes, price action push up to this place before there was a rejection. So meaning that this is the high. This is the high. That means if it's like this, we say we close high. This is the high. So it's like that. But if it is bullish, if it is bearish candle, if it opens here, for example, it will come down to this point, but at the end of the day, there could be a rejection. As it rejects its back, it closed low, because here the wick signifies that price action got to this place before there was a rejection. This thing you see here, this line you see here, is what we call indicator. This is it. All this one is indicator. By the time you start trading, you will see all these things. All you need to do is just choose one. And there's what we even call the RSI, relative strength index. All those ones are still indicators. We have the stochastic, we have Bollinger Band, so many, you know. At the end of the day, you have to stick to one. How to know when resistance and support are reliable? Because it's very important. You don't just see a place and mark it and say, oh, this place is a resistance and this place is a support. No, you have to know when, and to be sure that a particular level is a resistance level and the downside is a support level. You have to have the knowledge. And how do you do that? A resistance level is tested at least 3 times before it is reliable. For you to say this level is a resistance level, price action will get to it 3 times. Now, in the case of an uptrend, price action will hit the resistance level and reverse to the opposite direction like that 3 times. 3 times. Note, a resistance or support level is tested once or twice. When it's tested once or twice, it is a potential probationary resistance or support level. But when price action comes back to retest the 3rd time, if it comes back the 3rd time, it is a confirmation of a very strong resistance or a support level. So when you have 3 touches, price action came, touch once, a reverse to the opposite side. After a while, it will come back to get to that same level. It will reverse to the opposite side. It will still come back again and retest. Once it retests the 3rd time, it will reverse and the signal to the downside will be very, very profitable. So as a price action trader, as somebody who is advanced in trading, once you see that double top, once you see that, You just place your trade and allow it to run, allow the profit to run. We say a level is a resistance or support because more sellers. Because why do we say a level is a resistance and a level is a support? It is because more sellers and buyers are waiting. They queue up at those levels to sell or buy because they are very sure when the price, when the trend hit at that resistance level, the price will reverse to the opposite direction. So what they do, as once you open your chart and you want to place your trade, you want to place an order, you first of all map out the resistance and the support level from the higher time frame. That's where you do your analysis. So you now wait after you have mapped out all those areas, the support and the resistance level. How do you identify all those places? Those points, because price action has gotten to that place, and you see price action has touched that place, return, reverse, touch, and reverse 3 times. Not at the same spot. There could be a little distance. Maybe if he moves from here, touch, reverse, as it's coming down, it will go up again to retest. So once you open your chart, you will test, you will just know that, okay, this place is a resistance level, you mark. You go down, check. This place is a support level, you check. In between, you will see where price action touches like 3 times again. You map out all those things. You put your horizontal line. Then you now scale down to your time frame that you use for your execution. Then once you scale down, all you need to do is you wait for price action to get to those levels before you trade. We trade from the bounce. We trade from support and resistance level. Like I told us, you don't need to wait until price action get to the top. In between can be a resistance. In between, there can be a support level. So once price gets to that support level, you know what next the price is going to do. It's either the price will go bullish or if it will reverse and be bearish. If the price was bullishing, if it's going up before, once it get to a resistance level, it will turn. But sometimes it can decide to break through. That means that support level is no longer, that resistance level is no longer valid. It will break through. As soon as it breaks through it, it will come back to retest that same place. Now that place, the resistance level, will now become a support level before it starts trending up. So it's like that. So advanced traders, what they do is they place their order at that support level or a resistance level. If once you are advanced, you don't need to start watching your chart every day. You do your analysis and place your trade. You place an order. You can place a sell order or place a buy order. Once you place a buy order, I will still teach us all those ones. Once you place a buy order, is an order that once price get to that level, it will activate your order. Just like, for example, you are saying something is €5, for example. At this point, I don't want to buy. I want the price to come down. I want the price to come down to a certain level before I buy, I want to buy. So what you need to do is you place your order at that level, that price level, because every level there is price. You put your order there until the price fall to that level and activate your order, or You put your order above until price get to that level. It will before it will activate your order. If it does not get to this price, does not get to that level where you place your order will not be activated. So that means you are not in the trade. But once order price action get to that level, it will activate your order automatically. You will now be in the trade. So that is how it is. People who goes to work, they have their own traditional job that they do. What they do is every day they do analysis, do their own analysis, then place an order. It can be a buy order or sell order. So I will still teach us that one. So we should not worry. Having said that, we've come to the end of this segment, and I urge you guys that you should subscribe to my YouTube channel because all these things I'm giving you guys is just for free. The only thing you can do to assist me, to encourage me, not to assist, to encourage me for me to keep releasing this thing free of charge is for you to subscribe. How do you subscribe? It's just for you to hit subscribe button. You don't need to register, don't need to fill anything. You understand? It's free. You just hit the subscribe button. Then you hit the like button. You share it to your friends. Even if you are finding it difficult to understand this, that does not mean that you should not watch the video again. Rewatch the video, rewatch it again, rewatch it. By the time you watch like 2, 3 times, you will understand it. I've kept this thing very simple. I'm very sure this is the simplest way anybody can learn trading. Because like during my own time when I was, you know, when I dive into this trading stuff, I went through a very tough time because I kept paying, attending online classes. At the end of the day, I'm not really getting anything. Nobody wants to just pour everything out for you to understand. They just want to take, but I don't blame them because it's something that is very, it's complicated, but you just need somebody that will, like us, that will make it simple for us. That is how it is. When I learned this thing, I took my time. I said, okay, instead of stressing people, it is better you make it simple because financial market is one of the biggest market in the whole world. Ask, do research on your own. If you have the technical skill, the technical ability, if you study very well, you know how to trade, you know candlestick patterns, you know how market moves, you always make money from it. I'm not saying it's something that you just dive into and start making plenty. No, an income. Just like you open a business, cash flow, little by little by little, it's like that. Once you trade, you know how to trade, you know where to put your stop loss, you know when to enter the market, when to place your trade, and where to put your target, because all those things are very important and they are key to know. So on this note, I thank you all for your support. And like I said, if you want one-on-one coaching, just send me an email, then we talk about it. Then we can schedule, I will put you through. I'm always available for any question. If you have any question to ask, please do so. Thank you so much. My name is Sunday again. Have a blessed week ahead. Thank you.